Well, let's talk about, before you present some of your slides, but let's talk about your career and shift to that. Where'd you grow up? I forget.
I grew up in a small town, 3 small towns in South Jersey till I was 9, and then I moved to Richmond, Virginia when I was 9. I was there till I was 18.
And what did you study in college, and what were your early career aspirations? You didn't always want to be an investor.
I was an English major my first 2 years, and I wanted to be an English professor. My first semester of my junior year, I took a course in economics so I could read the newspaper, because I wasn't very good at it, even though I was supposedly an English major. And fell in love with the subject and crammed an economics major in. I think I took 18 out of my last 21 courses were economic courses, something absurd like that. And then I wanted to be an economics professor. So I wanted to teach. I love teaching.
So yeah, you have teaching in your genes, it sounds like, at least it called early. What?
Well, I also have a dropout in my genes, because I went to get my PhD in economics at Michigan, and then I lasted a semester and a half. I didn't handle them as well as you guys handled them on the football field back then. Anyway, I lasted a semester and a half, and I dropped out, went to work construction for 6 months, and then my first marriage, which was a practice marriage, in at 22. In at 22, out at 23. Don't get married at 22, okay? It was my first great cutting my losses, okay? Oh, actually, she cut them, not me.
We have her here.
Anyway, she lived in Pittsburgh, and she was more connected than I was, and I got a job at Pittsburgh National Bank through her stepfather.
And for those who aren't in the financial services industry, can you explain what exactly a hedge fund manager does, and how is that different than a traditional money manager, in simple terms?
I have no clue. Hedge fund has become the wildest term out there under the most gigantic umbrella, but I think the original concept was you borrowed, you were able to borrow money. So you didn't just, if you had $100, you might invest 120 or 130 of it by borrowing, and your fees were a percentage of the profits you made for your client. Pre-hedge fund, you would just charge 1% of whatever the client gave you. Under the hedge fund format, there's really the only 2 things they have in common is they generally use leverage, and they generally charge the client as a percentage of profits.
Okay. And you started your company, Duquesne Capital, in 1981, I believe. When you started your company, so, shift back a bit, how old were you when you started your first fund, and how much did you raise?
Well, I was 28 years old. When I was 27, I was Director of Investments for Pittsburgh National Bank. I was running $6 billion, and I was doing a pretty good job because the Shah of Iran went under, and I had no experience whatsoever, so I said, this is easy, let's put all our money in oil stocks and defense stocks. If I had been a little older, a little wiser, I would have diversified. It went up a lot, so everybody thought I was a genius. I wasn't a genius, I just didn't know any better. So I go to this dinner in New York. I'm making $43,000 a year, and I give a presentation on the gold, and the guy says, you don't sound like you're from a bank. Why don't you start a firm? And I said, with what? I'm worth about $4 grand. And he says, well, I'll pay you $10,000 a month to talk to you. So I started Duquesne Capital, and he said, you can raise money. Well, I'm such a good salesman, after a year and a half, I'd raised $900,000. So that's what I started with, $900,000. 2 years later, the guy that paid me $10,000 a month to talk to me, I woke up one morning, and he was going to jail. He had some scheme, and it cost Chase Bank $256 million. By then, I was up to a grand total of $7 million with a 1% fee. For those of you who went to the wrong school, I know all USC people can do the math. I had $70,000 a year in revenues, and my overhead was $160, and I was in deep, you know what. So that's how it started.
So started small. You started small, but still you started young. At 28 years old to raise $1 million is no easy feat. In the introduction, I did say at the time you retired in 2010, your firm was managing $12 billion. So the growth was pretty stratospheric. give us a couple quick answers just to educate us. What is a typical annual return for a hedge fund these days? Like, what's a good hedge fund return?
Today?
Yeah.
I'd say people are pretty happy and pretty proud. I'd say 12%.
12%.
12% a year.
12% a year. So over the course of 30 years that you ran your fund, what was your average annual return?
30.4, but who's counting?
And you know, they're up and downs, particularly in hedge funds, because you make big bets. How many down years?
Zero.
Zero down years. So if you have the same question that I had, which is, have you invented a time machine yet, and can we go back and invest in your fund? The answer is no, unfortunately. You must have made a lot of people a lot of money, and you know, applying these same things. So talk about your investment philosophy and why, you know, you got those types of results. How did you do it?
Well, my idea of risk control is a little non-conventional. I like putting all my eggs in one basket and then watching the basket very carefully. I think, I don't know what they teach at Marshall, but at most business schools they teach, I think, a lot of nonsense called risk-adjusted return and diversification.
Ouch.
As a money manager, if you look at a normal portfolio, most people will make 70–80% of money that year on 2 or 3 ideas, even though they'll have 30 or 40 things in their portfolio. My concept was to put into those 2 or 3 ideas that I had the most conviction in. I was also lucky to travel across asset classes, so I traded commodities, currencies, bonds, and equities, and it gave me the discipline. If I didn't have a good idea in equities, I was happy to have no equities, or the same thing with bonds. So when you have a quiver with a bunch of arrows in it, you can usually find something to put a lot of money into. The only other thing I'd say is too many investors look at the present. The present is already in the price. You have to think out of the box and sort of visualize 18 to 24 months from now what the world is going to be and what securities might trade at. You know, what a company's been earning is ridiculous. It doesn't mean anything. What you have to look at is what people think, what a company's earning, what people think it's going to earn, and if you can see something 2 years that's going to be entirely different than the conventional wisdom, that's how you make money. My first boss used to say the obvious is obviously wrong. If you invest in conventional wisdom, you're going to lose your butt.
Because everyone's already there.
Stan Druckenmiller manages Soros's Quantum Fund. I asked him about the events last September.
It was inevitable. It was a conclusion that could not be avoided under any intellectual thought process. And I must say, as the person actually managing the fund, that would have led me maybe to do $2 or $3 or $4 billion. And that was where the combination of experience, courage, whatever you've heard about this man, came into play, because it was he who pushed very, very hard on me to take the position to where we took it, and actually wanted to take it further, but we didn't. We ran out of time.
Yes.
Soros leveraged his portfolio and ended up betting more than the entire value of the funds he managed.
But basically, you took the whole quantum fund and bet 1.5 times that. That's really called betting the ranch.
Well, no, actually, in terms of the risks we take, it wasn't even a full exposure, because the risk of loss was maybe 2.5%. So if 1.5 times 2.5% would be, let's say, 4% loss, it wouldn't have killed us.
So that really was a fabulous one-way bet.
That was. It was a safe bet, but it's a question whether it was worth making it. That bet has been available for the last 10 years, and it only paid off at that particular moment. So this is where this equilibrium reached a climax.
It's really a once in a decade, and that's when he is really that's when he is George Soros. That's when he just says, you can't have enough of this. And if there's one thing I've learned from him, is that when you're right and you know something, you really feel it, you can't have enough. And the biggest mistake, if I had to sum up his investment philosophy in one sentence, it's that it's not whether you're right or wrong, you just have to have the max on when you're right, and that's his unique innate ability.
A lot of people are very encouraged by certain areas of the market, particularly the AI boom.
There's always stuff to do. We had a hard landing in 74, 75 in chemicals and oils, and that stuff did great. I'm sorry, go ahead and answer your question.
Well, do you think that all of AI makes it through this recession, or do you think that some areas of the market, particularly in AI, start to look like they're in bubble territory?
Well, all of AI is not going to make it through whether we have a recession or not, because they haven't separated the wheat from the chaff yet. But I do believe, unlike crypto, I think AI is real. It could be as transformative as the internet. It's a huge thing. And I think I've argued publicly that if staples can go up in price in a recession, why can't a company like NVIDIA, if their orders and earnings go up 70% in a hard landing, which is what I think would probably happen, it's not clear that NVIDIA goes down despite the lofty valuation level. History has proved if you have very good earnings in a recession and they're sustainable, if they're not, the market somehow figures it out, those stocks will do just fine. So we have some longs, we have some shorts, and the AIs have sort of dominated the long portfolio for 5 or 6 months.
How do you think about going short in this market?
Our shorts have been fine this year, except my index shorts, which have been a disaster. But we always short the same way. I just try and look at the current situation, and then I try and think of a situation 12 to 18 months from now based on my forecasts. And I think if I think the security prices are going to be less, then I short them. Frankly, I'm not sure I've ever made money. If I took back the last 40 years, I'm afraid to look. I've never had a down year, but I'm not sure I've made money in shorts. I like it, it's fun, but you can get your head handed to you. And it's a game that really only professionals, and the math's against you. If you're dead wrong on a long, you can lose 100%. If you're dead wrong on a short, you can lose 10 times your money. And when I was at Soros, I shorted $200 million worth of internet stocks in March of '99, and in 3 weeks covered them at a $600 million loss. I lost $600 million on a $200 million investment in 3 weeks. I was short 12 stocks. They all went bankrupt, every one of them.
Don't try that at home.
So,
well, I mean, to that point, when you look at the AI kind of boom here, are there lessons to be learned from the dot-com bubble?
yeah, there are definitely lessons to be learned. Don't get emotional, don't get crazy. But I will say this about the AI. NVIDIA bottomed in October in the low 100s. It's true, it's 380 or 390, it's in nosebleed territory. If this is a secular move, if this thing is real, you just don't have 10-month moves. That's not how it works. Even the dot-com bubble lasted 2.5 years. For many of the guts of the internet, it lasted 4 years. The Ciscos, the Sun Micros. So, could NVIDIA go down materially in the short term from any point? Yes, but I would be surprised if I'm right on AI and the impact on it. I mean, it's already making the top coders 7 to 8 times more productive than they were 5 months ago. If it's as big as I think it is, NVIDIA is something we're going to want to own for at least 2 or 3 years, not for 10 months, and maybe longer.